Okay, we're going to do fiscal and monetary policy. Fiscal policy is done by the U.S. Congress. It's a bill made into a law signed by the President, and monetary policy is done by the Federal Reserve. So, first of all, fiscal policy. Okay, so the Congress makes the budget. All revenue bills, meaning tax bills, start in the appropriation committees in the House of Representatives. It is in the Constitution that revenue bills start in the House and then go to the Senate. And they use their tax money, obviously, for a whole variety of things. Budget right now is about $3.67 trillion, although we go over roughly $1 trillion a year. So we can have a budget surplus, which we've only had once in my lifetime, I believe, and that was 1 year under Bill Clinton. Normally we have a deficit. That's when we spend more than we bring in. As I just said, it's roughly $1 trillion. The deficit plus the debt we pay on that deficit equals the national debt. We are in 2013 right at $16.7 trillion debt. And so that's why we have to borrow money. China is always number one, but very close behind is Japan. Of course, you guys may have some debt owed from the national government to you if you have any kinds of saving bonds. Okay, so expansionary and contractionary. Expansionary, how do we do if you think about FDR and you think about the New Deal? He was increasing government spending, therefore hoping that more people will be employed, and therefore if there are more people employed, they're going to buy the products, and that's going to mean they're going to pay taxes, and that's going to go back to the government. That's a liberal view. A conservative view is to decrease taxes so that people have more money to spend, hoping that if they have more money to spend, they will indeed spend it, causing more jobs to be created, of whom the workers will then pay taxes. And then obviously contractionary is the opposite, when you want to decrease the government spending and increase taxes, both of which are going to slow the economy down, both of which here would increase the economy or improve it. Okay? Then we go to the Federal Reserve. Federal Reserve is a part of the executive branch. The president appoints the head of the Federal Reserve and the Federal Reserve Board of Directors who head Federal Reserve banks around the country. They're approved by the U.S. Senate. The head of the Federal Reserve, once appointed by the president, cannot be removed by the president. So that's to make sure that the tasks being performed are so important that it does not become political. So, for example, the big one is the rate charged by the Federal Reserve to banks. So this is the prime lending rate. That means that the Federal Reserve will loan money, and if you look at your bank dollars, they actually say Federal Reserve note on there, to the big lending institutions who then will loan it to smaller ones who will loan it to you. So if the prime lending rate is 2.0, maybe you have to pay 4% interest. Reserve requirements are how much money needs to be in the bank. They may say all banks have to have 10%. And then there are other open market operations that can be demanded by the Federal Reserve. They're using a variety of these things at any one time to either increase or decrease inflation. For example, if prices are going up too much, they're going to increase the amounts of the price of a loan, because that would mean effectively buying a car or a house will go up, and that will decrease spending. Likewise, if there's not enough spending, they're going to decrease interest rates or decrease the percentage of money that must be kept in a bank. So that is called monetary policy. Congress does fiscal policy. And That's it.